Let's now split the income tax expense of the subsidiary. Now, this calculation often causes some confusion, so please listen carefully that you understand fully what happens in this line. The information told you that the profit before tax of both companies is equal to taxable income. So we know for income tax purposes, we do not need to adjust anything with regards to profit for the year to get to taxable income. If I have income tax expense and I have profit for the year before tax, what can I calculate? I can calculate my effective tax rate. Now, to split the income tax expense in a pre and post acquisition date period, you take that effective income tax rate and apply that to your adjusted profit for the year before tax in each of the columns. So this percentage that you calculated there, apply that to the 65,000 Rand to get the related income tax expense. Take the 166,500 and apply the effective tax rate to that, and you get the related income tax expense. Do you see that I did not take the 64,000 tax expense and say 3/12, 9/12? Why can I not do that? Why can I not split the income tax expense evenly? Because up here, you didn't split every single item evenly. So therefore, you apply the effective tax rate to the adjusted profit before tax to calculate the related income tax expense. This happens down here in calculation F. This 64,820 over 231,500, that is every time your effective tax rate that you then apply to the adjusted profit before tax amounts. Now that you've split the total profit of the subsidiary for the year into a before acquisition date profit and a since acquisition date profit, you are able to use the other information in the example to calculate the retained earnings of S at acquisition date. That 46,800 represents the first 3 months profit of the subsidiary, 1 January to 31 March. To that, you add the retained earnings on 1 January 20x9, which was given on the trial balance. These two amounts added together represents your retained earnings at acquisition date of S. There was no ordinary dividend declared in those 3 months. But because we have preference share capital issued by the subsidiary, whenever we are looking at the equity of S and specifically retained earnings of S, we always have to ask, who is that attributable to? Now, in this example, we're working with cumulative preference shareholders, and we saw on the trial balance that 10,000 Rand 1 year's fixed annual dividend was declared. But preference dividends accrues over time. So at acquisition date, the preference shareholders at acquisition date is already entitled to 3 months of that annual preference dividend. So that 10,000 multiplied by 3/12 gives you 2,500 Rand. That 2,500 Rand is not attributable to the ordinary shareholders. So by excluding it from the total retained earnings at, you are left with the profit or the at acquisition retained earnings of the subsidiary attributable to the ordinary shareholders. And all you will have to do is that 2,500 Rand you will move out to the preference shares, and that will be a portion of the equity of the subsidiary at acquisition date that eliminates against the preference share investment and the preference share NCI. It's similar to what we did in example 8.2, but I'm not doing this because the preference dividend is in arrears. It's not in arrears. It has been declared. The reason I'm moving this 2,500 out to the preference shareholders is because they are already entitled to that as your preference dividend accrues over time. You'll see the effect of that in your at acquisition consolidation journal entries. But now you have the retained earnings of S at acquisition date attributable to the ordinary shareholders, and you have the profit of S since acquisition date. When you are dealing with a situation where it's non-cumulative preference shares, this portion that you move out, the 2,500 in this example, will only happen if the preference dividend was also declared in that year. And because you will perform the consolidation process at the end of the year, that information will already be available. Now that you have the at acquisition retained earnings of the subsidiary, you can write the at acquisition consolidation journal entry, and we will first do the one for the ordinary shares. First, have a look at what is still the same. The ordinary share capital eliminates against the investment by the parent, which is the cost, and you get that amount from the trial balance. You measure NCI, and the fair value in this instance was given. Then you have to eliminate the at acquisition retained earnings. But remember, we do not have financial statements of S at acquisition date. We have a trial balance that indicates retained earnings at the start of the reporting period, the 7,500. And then the profit for the first 3 months of the year that represents the before acquisition date profit that is included in the at acquisition retained earnings of S. We still have those profit and loss items as separate line items in the trial balance of S as my starting point. So to eliminate the 3 months profit, you will have to eliminate the amounts from the individual profit and loss line items. Please note I'm eliminating. I'm debiting revenue and I'm crediting the expense items. These amounts you will find in the column before acquisition date in the allocation split calculation that we looked at just now. So by looking at the yellow amounts, that is now eliminating the retained earnings at the beginning of the year and the 3 months profit since the start of the year up to acquisition date. But that still represents the total retained earnings at acquisition date. Only the portion attributable to the ordinary shareholders should eliminate in this at acquisition consolidation journal entry. And to give effect to that, you must remember to move a portion of that retained earnings out, the 2,500 Rand, to the preference share at acquisition consolidation journal entry. If you now take the following amounts and you add the net effect together, the retained earnings at the beginning of the year, the profit for the 3 months before acquisition date, and the portion attributable to the preference shares that you exclude, the total net amount that you end up eliminating is now that 51,800 Rand that you will see in your split calculation as the retained earnings at acquisition date attributable to the owners of the parent. So you are still doing what you've been doing up until this point. The only real difference is that there's a portion profit included in the retained earnings of S that you cannot eliminate against the retained earnings, as you still have to eliminate that against the individual profit and loss items. And now this at acquisition consolidation journal entry has an enormous effect on the consolidated SPLOCKY line by line. After you've now eliminated the equity against the investment and measured NCI, you end up with goodwill from this at acquisition journal entry. Please note that this 51,800 represents the at acquisition retained earnings of the subsidiary attributable to the owners of the parent as ordinary shareholders. Now we can also prepare the at acquisition consolidation journal entry, and specifically for the preference shares, where we eliminate the preference share capital, the investment in the preference shares from the separate financial statements of the parent. We measure NCI in preference shares always at fair value, and that amount was given. Now you can see the effect of that 2,500 that you moved from the at acquisition consolidation journal entry for the ordinary shares into the at acquisition consolidation journal entry for the preference shares. You usually do that on the analysis, so that's what I mean by moving out. We had the total retained earnings of the subsidiary at acquisition date, and we determined that 2,500 Rand of that is attributable to the preference shares, not because it's in arrears, but because it accrues over time. And 3 months preference dividend already accrued to the preference shareholders. That's why it's part of the at acquisition equity of S that eliminates against the investment in the preference shares and the NCI preference shares. Now, after you've done your elimination, you end up with a gain from bargain purchase. Please remember what we did in Chapter 8. If you have goodwill in the one and gain in the other, you need to offset. The gain is smaller than the goodwill. That's why we will offset the gain against the goodwill with the next consolidation journal entry.